Hey guys, what's up? In this video, I'm going to talk about why you should lose less more often. The 15 versus 30 delta credit spread debate shown in pure math so you can make an educated decision on which is best for you and why. So let's dive into the numbers. Okay, so first off, there are some important numbers we need to know. When we're looking at a 15, when we're looking at a 15 delta, there's something we need to know. So 15 delta versus a 30 delta. Let's look at the math and what this means. First off, delta is just an understanding of, based on volatility, based on the stock, how far away from the stock are we. So for instance, a 15 delta would be further away than a 30 delta. So if we're looking at a stock chart right here, and let's say the stock is here and we're trading a put credit spread, meaning that we want to be further away from the stock price, a 15 delta would be here and a 30 delta would be here. So you can see the difference. A 30 delta is a lot closer, which means we make more, but we have a lower win rate. And the 15 delta is here, which means we win less, but we lose less because the win rate's a lot higher. So how is this determined? What is our theoretical probability of a win rate based on our delta? Well, the delta, the inverse of the delta, is your probability of winning the trade. So you simply take the width of the spread, so let's say it's a $1 wide spread like most people trade, and we subtract it by 15. So 1 minus 15, that's going to give us a what? A 85% win rate. So 85% of the time we are going to win with a 15 delta. Now for a 30 delta, what's our win rate? Well, 100 minus 30, we're going to get a 70% win rate. So you see here there's a 15% difference in win rate, so 15% difference. Okay, we know that so far. Next, let's take a look at average credit. What credit are we expecting to make here and there? Well, roughly, we can expect to make the delta. This, again, is very rough math. But again, we can collect around 15 cents at a 15 delta and around 30 cents at a 30 delta. Okay, so that's a 15-cent difference. Okay, now how does the long-term win rate play out? Now that we know our average win and our win amount, we can determine what our expected long-term return is. Now, we're probably going to get a 0 because that's how this simple math works. Are you trying to make money with credit spreads, or just trying to understand my strategy, or trying to find a strategy that works in any market? Well, I put together a free course called the Ultimate Credit Spread System course. It walks you through how it works, every strategy for every different type of market, how to generate monthly income, the exit rules we use, the minimum credit, trade sizing, and all that. So if you're interested, click the description down below to get free access. Anyways, hope you enjoy the rest of this video. But to determine your expected return, you simply do the amount of times you win times the amount you win when you do win minus the amount you lose times the amount you lose when you do lose. So again, for a $1 wide strike, it's going to be 1 minus 15, so it's going to get you 85. And so again, this is going to zero out. Why? Well, because you have the same numbers on each side. So that's why it's not going to work out long term to do this, because there is no edge to this trading system. But that's why we add stop loss rules. So again, if we add a stop loss rule, I'm going to exit at 200% of my max loss, then that changes from 85 is the amount of times we win. Again, this is roughly. We win 15 minus, we're going to lose 15 times, and if we're going to lose 2%, so that means we're going to lose 30. So now we can determine what our long-term expected range is. So 85 times, we're going to win 15, minus we lose 15 times, times we lose 30 each time. That's going to give us an $825 expected return. So over 100 trades, trading one spread, we can expect to make $825. Now we know that number. Let's take a look at this number. Okay, so as before, like I mentioned, I wanted to show this to show that when you're trading expected ranges based on these deltas and percentages, it's going to be 0 because markets are efficient and they don't work out well. But when we add edges, when we add our ability to increase our win rate more than delta, different things like that, then we set ourselves up, which is what this whole YouTube channel is for, to show you how to get that edge. Anyways, if we're moving on here, let's use the same stop loss type of system here. So we're going to have in 70% win rate, so we're going to win 70 times, and when we win, we're going to win 30, minus we're going to lose 30 times, and when we lose, if we're using a 200%, we're going to lose 60 cents. So let's take a look at the math. What does this give us? Here we go. We have 70 times we win 30 each time, we lose 30 times, and we lose 60 each time. Oops, I did that wrong. Times 60 each time. That gives us a $300 long-term win rate. All right, so the difference here is it looks like that the 15 delta is better for our trading, right? We have a lower expected return. Okay, cool. So now that we know this, if we're trading based off deltas, trading based off normal trading levels, it is more profitable to be here, right? Because you're going to make 825 versus 300. All right, now let's start to add some trading edges like I discussed. That's the whole point of this channel and the whole point of helping you. If you don't have an edge, then you should do this, which is just going to be a standard default, basically type tasty trade setup. But let's talk about some edges. How do you have a trading edge? Trading with the trend is your #1 edge. So again, there's so many different ways to do this, but to keep it bare minimum simple, go to your chart, add on indicators, add a simple moving average, which is what this is, change your length to 50, and boom, you're set. Now, if you simply do this, and you trade put credit spreads when the stock is above it, and sell call credit spreads when the stock is below it, this is an edge. With this edge, this is the probability you get. You go from this to this. So we go from an 85% win rate with a 10 delta, or with a 15 delta, to an 85% rate with a 10 delta. So now we're trading 10 deltas, so we're going out even further, and we have an 85% win rate. And so what do we get to do with this? Not only that, we get to change our stop loss rule. So edge #1 is going to be trend. This is what the trend gives us, a 10 delta with an 85% win rate. This is what this strategy gives us. We can do a 30 delta and have a 71% win rate. So these are our type of approaches. So when we follow the trend, these are our percentages with the delta. So by default, a $10 or a 10 delta should have a 90% win rate. But with this, we have an 85% win rate, and so again, we are lower than the average, but I'll show you here as the next part is going to benefit that even more. Next here, we have a 30 delta, which should be roughly a 70% win rate, but it becomes 71. Now, how do these play out? Well, we also add a stop loss here, which is our second edge, but not just any generic stop loss. We're going to exit when our strike is broken. So exit when strike is broken allows us to only risk $40 in this sense, and allows us to only risk $20 in this sense. Why? Because when we exit when our strike price is broken, our short strike price is broken, now the spread is trading at 50 cents. So 50 cents is our new max loss, and that becomes this. So now let's do the math here. So you're going to win 85 times, you're going to win $10 each, minus 15 times 40. I'm pretty sure I don't have to do this math anymore. I can just quickly do it here. Anyways, 85 times 10 minus 15 times 40. That gives us a $250 long-term expected value. Now let's look at this one. So we're going to win 71% of the time. We're going to win $30. Then that means we're going to lose 29 times, and we're going to lose $20. A $1,500 expected return. 1,550, $1,500 expected return. So, what have we learned here? Well, if we're going to trade purely based off deltas, ignoring trend, ignoring direction, and just putting on a put credit spread every single day, and you just want to follow a 2 times X stop loss rule, this is your go-to. A 15 delta with roughly an 85% win rate collecting 15 cents. Looks solid, right? $825 expected return with a 2x stop loss. However, if you want the greatest return, you need to use a trend following strategy, 30 delta, stop loss of 20 cents, or roughly when your short strike price is broken. This gives you a $1,550 expected return. So again, if you want to learn how to implement this for yourself, I literally have a free course out there, linked down below, that tells you and walks you through how to do this step by step. But simply, I'll explain it to you right now, just because you need to know this stuff. When the market is above the moving average, we're trading put credit spreads. When it's below, we're trading call. So let's say it's above, we're trading a put credit spread. What we're going to do is we're going to look at the stock's current close price. We're going to multiply that by 0.99, aka what's 1% away from the stock price. That's going to give us our short strike. And then once we have our short strike price, then we're going to buy the strike below it to set up our call credit spread. That's how you set up the trade. Our expiration date will be the current date plus 7 days. So plus 7, and then round to the next Friday. So today is February 6th, so that means that it's going to go to February 13th. It's going to be 7 days, and then if we add to next Friday, our expiration date would be September 15th. If today is the 6th, that means our expiration date would be September 15th, just for example. And we're going to use a stop loss where we exit when our short strike price is broken. This is the rough rules. If you follow these rules, you can hit these setups, these criteria, and have a long-term expected return with a 71% win rate. All right, guys, that is my math explanation, the system, the strategy behind how and why you should lose more. I should say that. Lose less more often. Anyways, if you enjoyed this, please smash the subscribe button. I will see you in the next video.